look at how markets started this week.
The only disappointment here is that the grey market premium has shrunk significantly.
Earlier today, its benchmark indices hit record high levels.
Welcome to Markets by Zerodha. I'm your host Bhavya Dua. Last month, we spoke with Sahil Kapoor from DSP Mutual Fund and tried to unwrap the early signs of the market and the economy highlighted in the DSP Netra report. And since many of you liked the insights-packed session with him, we brought him back to unpack this month's report as well. In our conversation this time, we talked about how gold and equity has performed in emerging economies, how India's equity market stands against the rest of the emerging markets, how India's equity market stands against the rest of the emerging economies, what is driving the foreign investment flows and corporate funding in our country, why promoters are selling small caps and mid caps, and what that really means for you, analyzing how Chinese tech and Indian banking valuations stand, and how do the trends differ when it comes to consumer staples versus consumer discretionary. So let's dive in. Welcome back on Markets by Zerodha. Sahil, thank you so much for taking out the time and discussing October's DSP Netra with us. I think the last time we discussed the Netra of September, people really liked the insights that you had to share about it, and I hope the same happens this time as well. So a few topics that I want to throw light on at this point in time is how India stands as against other emerging markets. What's the performance of a country like? How are different asset classes, for example, gold or equities, shaping up? Where do they stand as against other emerging markets again? And what's really happening in the corporate fundraising space? How are the flows coming into our country? What's happening with the flows in the supply inside of the country? And also then discussing about certain sectors. So to start with, I would want to start with gold and equity performance in the emerging markets, because it's been really interesting to see gold outperforming equities in most emerging markets, except for India. So do you think this says something about India's economic path compared to its peers? Is there something unique going on in there?
Sure. So first thing is that there is nothing unique per se, because when you go back to, let's say, 2017-18, in India also gold was beating equities. So it's more cyclical in nature. And second thing is, why do we club emerging markets together? Why are we part of that bucket? The reason is that most emerging markets sees huge amount of currency depreciation, right? And why does this depreciation happen? A, it could be because of very high inflation in phases. It could be because of political instability. It could be because of some geopolitical tensions, war, border tensions, etc. So most emerging markets lack a very important factor, which is a very strong institutional framework. Okay, and because of that, you see some event will occur and a currency depreciation event will occur, and that depreciation causes very high gold returns in local currency. And what do I mean by local currency? When you are sitting in Turkey, if you buy gold, so Turkish lira returns for gold will be impacted by how Turkish lira depreciate, right? So in most emerging markets, the benefit of currency depreciation gets added to gold prices. Okay. So this is one of the key reasons why gold performs very well across all emerging markets. And in fact, it has done well even in developed markets. It's not only emerging markets. And the simple reason is that the whole world has been binging on debt for the last 3 to 4 decades. Debt levels have been rising significantly. And if you and I believe that gold is a form of money, then if you increase debt or raise debt by a very wide margin, you are causing what is called currency debasement. You are reducing the value of currency, whichever currency you talk about, right? And that causes gold to do well. And maybe when you think about equity markets, a lot of people are enamored by equity because they are fashionable. You can talk about them parties, right? This stock or that stock. But think about this, sitting in an emerging market, buying a piece of rock like gold and not doing anything, you beat everything else. It's quite fascinating. You don't have to pick an active manager or select a stock or select an index, etc. And gold does the job for you. Right? So I think gold is a very important asset class. Specifically, when you are sitting in an emerging market, you can't ignore it. So I think most likely, if you have adverse market conditions in India for equity, gold might again come back up and beat equity over a longer term in India also. So it is more cyclical in nature, nothing new and unique about it.
Done. And do you think with the geopolitical instability that's going around and central banks also heavily investing in gold, that also has a factor to play in right now?
I think it's very difficult to sort of quantify how much of the impact geopolitics has on gold prices, but it is assumed that it has, right? When and why this assumption is made that in times of crisis or a war or geopolitical tensions, a lot of people will have lesser belief or faith in fiat currencies or bonds of a particular country. They would want to have something tangible, right? Something which will hold value even if the domestic financial system collapses. So gold in that manner gets benefited from these events. But let me also re-emphasize that this is a perception, a justification. You cannot have a hard data put together and say that XYZ will be the impact, right? But over the last 1,000 years, empirical evidence tells you that gold is one of the only disaster hedges in the world. Okay, and let me maybe dig one level deeper. Gold jewelry is known to be the only disaster hedge, and no other form of any instrument proves to be a disaster hedge. For example, in times of a war or loot and plunder, etc., gold jewelry becomes one of the most important diversifiers and store of value.
That got it right. So investors are often told that even equities always win over the long run. Given this data, should Indian investors be thinking differently about gold compared to other emerging markets?
So, Bhavya, this statement that equities win over the long term, it's been fed to us, right? Let me tell you, it's incorrect, right? As a mutual fund participant, as a investor, and maybe as a professional who works in the asset management industry, you will not hear many people say this, right? But the problem is that all of the data for equity markets winning over the long term comes only from two countries, which is United States and India. If you go and ask this question to a Chinese investor, what will he say? The answer is no. If you go and ask this question to a Japanese investor, the answer is no, right? If you go and ask this question to any other Asian country investor, our neighborhoods, right? Sri Lanka, Pakistan, Indonesia, Bangladesh, maybe not Indonesia, but most countries, Russia. If you start putting data together, you'll find that it is actually an exception, right? Equity markets winning over the long term is an exception. And the reason is that equity markets do not win over the long term. Companies do. And which companies do? Companies which are able to earn a return higher than their cost of capital. Only those companies beat other investment avenues over the longer term. So this is as simple as that. And these good statements that equity wins over the long term, they have been oversimplified largely because you can put together 20, 25 years of data and then see that there are returns and then just repeat that line that yes, this will happen again. But there is no empirical evidence over that. And therefore, I think we have published data for 130, 140 years. And there are markets which have done exceedingly well over 100 and 130 years. No doubt about it, right? But we need to understand what are the conditions. And second is, we need to be lucky, right? What if you are born in a period with, let's say, if an investor started investing in, let's say, Japan of 1985, he enjoyed it for 5 years and then 30 years of no gains, right? So you have to be lucky, born in an era in a country which does well. So keeping this view in mind, I think gold becomes a very important hedge in your portfolio, and you cannot ignore the allocation for gold in your portfolio.
Then, so can we say, for example, if you're looking at asset classes, it shouldn't be gold versus equities, what will perform better over long run? It should be gold versus whatever company you think fundamentally can do well.
Yes, this is a framework. I think maybe let me rephrase it. How I think about it is to always think about the opportunity cost. And that is how you decide what investments should you make. So, for example, if a bond earns about 7 or 8%, the GSEC yield in India is about, let's say, 7% or so. If your investment is not going to earn 7% for you, then it's not going to be a good investment. So that is the first yardstick for you to think about, right? And then you put inflation in the mix and say how much I'm going to earn over and above inflation. So that will become a second yardstick for you to think about. Now, the third thing is that when you talk about equities, a lot of people believe that they will continue to deliver X returns, let's say 10% or 12% or whatever number comes to their mind over a 20-30 year period, right? But this may not be true if you buy them when they are very expensive. Okay, so for example, if you think about this, you buy a 100 rupee bond and it has a, let's say, interest rate or coupon of, let's say, 7%. So you make 7% return, right? And now think about an equity stock, right? Let's say the equity stock earns 5% earnings. It has 5% earnings over 100 rupees, right? So the earnings yield of that stock is going to be calculated by how much price you pay. So for example, if you're paying 25 rupees, price to earning ratio of 25 for 1 rupee of earning, which is like 7 rupee bond earnings. Let's say example of 1 rupee of earning, essentially you are making 4% yield, which is compared to 7% bond yield, right? So you are paying extra for the lesser return, right? And that will probably cause your returns to be lower in the future. Therefore, the more expensive purchase of equity, the likelihood that you will make lower money in the future goes up, right? So the trick is to buy stocks when they're cheap and therefore their earnings yield are much higher. So this is the comparison that you need to make. If you find opportunities which are cheap, well managed, have good return on equity ratios, then there is no doubt equity remains the most preferred.
Right, got it. So moving on from talking about equities and gold, we started also talking about emerging markets, the performance of these two asset classes in emerging markets. So now that we see India's outperformance as against the emerging markets, we see that India posted a remarkable 18.2% CAGR over the last 4 years, outpacing all other emerging markets and even during a strong dollar phase. So what factors do you think are behind this divergence?
Sure. So India definitely is one of the best performing markets, no doubt about it. If you put a pecking order over the last 25, 30 years, there are very few markets who have done as well as India, right? And even in dollar terms, India has done remarkably well. And the reason for that is very strong corporate earnings growth, right? That is one of the biggest drivers for India's returns. The EPS growth for Indian companies have been extremely strong, right? So for example, over the last 20 years, Indian companies have earned more than 10% dollar earnings growth. And I don't think there is any other index or country which has given this kind of number. So this is one of the biggest drivers. We can talk about why this happened, but I think this is the key driver, key differentiator of why India has performed, right? Now the question is, can we continue to do it, right? So that I think is a problem, right? For example, if your economy grows at 6% real and 4 to 5% inflation, so 10 to 11% nominal growth, expecting that in a country which grows at 10-11% nominal, that corporate earnings will grow at 25% or 20%. It's going to be a very, very tough task. It's not going to happen, right? Over time, they will converge over a 10-20 year period. And for the last 4 to 5 years, we have diverged. Let's say if our nominal growth has been 10%, our earnings growth has been 22-23%. Okay. Let me give an example of, what I mean by, that earnings growth can be closer to GDP growth and not the vice versa. So in the area where I live, I counted that there are about 18 saloons which have opened up. 18, right? So I joked with my wife that there will come a time when there will be more saloons than people living in our area. In the way that they are opening up, which that practically cannot happen, right? Because they will not be able to make any money and most of them will shut down, right? And therefore, profitability cannot exceed the pie itself in the longer term. And therefore, expecting that we will continue to deliver 20-25% earnings growth and therefore overpaying for India growth could be detrimental. Okay, so two things. One, India's performance is based on very strong earnings growth. Second is, can it continue, right? The answer to the second question is slightly more muddy. I don't think we can continue at the pace that we have.
So, what was the driving factor behind the corporate earnings growth initially for the last few years?
So two, three factors. First is that we had a very, very strong revival in top line growth, which means that sales growth, started picking up very, very well initially in the first 2 to 3 years post COVID. And the second factor was corporate margins improved significantly. Profit margins. And why did the profit margins improve? Initially, when COVID happened, a lot of companies cut back on their cost, whether it was employee cost or overhead cost, they reduced them significantly, right? And in the second phase, commodity prices declined. Okay. Both these put together propped up India's corporate margins significantly. How much? Corporate profit margins in the bad phase of COVID had fallen towards 7%. Okay. Now, currently, they are more than 12%. So, this 500 basis point increase in corporate margins, it caused our profitability to shoot up dramatically. Okay. And the third factor, which also occurred, was the new profitability, improved profitability that corporate earned, the higher profits, they tried to repay debt as much as possible. So, they reduced their interest burden also and further reducing their, costs and boosting their bottom line or boosting their profitability. So this sort of, helped corporate profitability by a wide margin, and therefore the performance that you see, which has happened. But this trend itself has an expiry date. That you cannot continue to reduce cost forever, right? And you cannot continue to enjoy very high sales growth. Both these trends die out over a period of time. And as we speak today, both these trends have already run out.
Right. So, if I had to ask you, then corporate earnings growth was the major thing that made India stand out so significantly among other emerging markets. Was this the factor alone?
That's right. So India's corporate earnings growth was very much superior than rest of the emerging market. In fact, if you compare, let's say, a country like China, in the post-COVID world, China's earnings growth was less than 2% CAGR, 2. And India's earnings growth for, let's say, if you take just NSE 500, was 24% CAGR. So that is the dramatic difference between these two countries and therefore the performance that you see.
Right. But it's unlikely that this will help India maintain that position going forward.
It can happen for a shorter time frame, but if you just put numbers together, we might wish that it continues, right? But hoping and wishing is not a good strategy. So the numbers don't align, right? So, and because the numbers don't align, we'll probably normalize. We'll come to a more sustainable base, maybe which is close to 10-12%. Then I think that is also not a bad number. Other countries not able to do 10 to 12% also, right? So we need to pull down our expectations, reduce them, and look at these realistic numbers.
Right. So while explaining about India, you mentioned about what was China's growth numbers, what were India's growth numbers, right? So on that context, if I have to diverge to talking about foreign investment flows, there's been this widespread belief that India would benefit from China's slowdown in terms of foreign investment. But the data isn't exactly backing that up if we look at that. So what's your take on why that prediction didn't really materialize?
So first thing is that predictions are very hard, right? And they are more imaginations rather than predictions, right? It's somebody's imagination that XYZ will happen. It has got no probability of happening or not happening. So we can just treat them as they are. Second is that very few people ask, why should it happen, right? Why should India receive flows if China is not receiving? What does history tell us about, let's say, global flows? So two things. One, when investors look at India or China or other emerging markets, it's a tiny part of their portfolio, right? When we are talking about FIs, so an FI sitting in, let's say, US or some other European country or some other location, when they think about their portfolio and they want to allocate to emerging markets, they're not actually thinking how much should I allocate particularly to India. When they're thinking about emerging markets, they're thinking as a group, right? And when they allocate to emerging markets, most of these flows come through passive flows, right? For example, they will pick a fund which invests across emerging market. And when they put, let's say, $100 in that fund, it will get distributed as per the weightage of emerging markets, right? So one thing is very clear: when emerging markets receive flows, India will also receive flows because we are part of that basket. And second thing is, if emerging markets are receiving higher flows, India will also receive higher flows. And this is what happened in the 2003 to 10 cycle, where a lot of flows for emerging market came to India also, with whatever weightage we have. Today, India's weight in emerging market is at its highest level that we've seen historically, right? In spite of that, over the last 3 to 4 years, we have not received flows. Okay, not received flows which are not commensurate with our market capitalization, right? Our size has become so large that a $10-20 billion annual flow is not very large. Okay, maybe let me ask a few questions which will clarify what I mean. First is that we, as I explained, we had one of the strongest earnings growth. We had one of the most stable currencies in emerging markets. We also had stable government, right? We had a very stable balance of payment. We had very high FX reserves. We had a fiscal deficit which was much better than most other countries in the post-COVID era, right? We had very strong corporate balance sheets, a banking sector which was very strong. Why did we not receive FI flows? Right? It's a very simple thing that most of these FI flows are passive. They're not thinking or actively seeking to invest in a particular country. That is one of the reasons, which also means that if you have a benign global environment, more conducive global environment, a more growing globe, it benefits India, right? You can think about it like a very good flat cricket pitch. If you have a flat cricket pitch, India is like, let's say, Virat Kohli. If you play Kohli on a flat pitch, he's going to hit a century, right? But if the pitch is very bad, maybe if other batsmen make 10 runs, maybe Kohli will make 11, right? But 11 is not 100, right? And that is what is the problem, is that even if we outperform in a harsh environment, that outperform doesn't really matter because the number remains too small.
Then got it. So if you're saying that we receive foreign inflows in terms of passive flows because they have a basket for emerging markets as a whole. So are there no active investors when it comes to foreign investment flows?
There are active investors, but
Then how does it shape the market dynamics for them?
their size is not too big, right? That is the issue, that there are not many large active foreign investors seeking to invest. And second, when there are active investors, they are, I call them tourist dollars. They are here to make quick money, right? They are HFT traders who are there for intraday trading or a weekly or a monthly trading. They do in and out, get out of the market, whichever market they are trading, whether India, China or whatever, right? You don't need that kind of flows. You need more sticky flows. You need flows which will come and stay, and that will make the big difference, right? So the answer to your question is yes, there are active participants. Their size is very small, maybe a fraction of what passive flows are. And second, many of those active investors are traders. They are not investors. So that doesn't benefit us over the longer term. And third point, which I have not made until now, that when active investors seek investing in overseas equities, will they buy stocks which are overpriced, right? So for example, India's premium over emerging market is right now at about 80-90%, which is too high, right? So for a single dollar of earnings, you have to shell out almost double the price for India versus other emerging markets. So that also becomes sort of a roadblock for some active global investors.
So can in future at any point active investors also become a huge part of foreign investment flows?
I hope they can. Yes. Yes, the answer is yes. It can happen, right? There is no doubt that it can't happen. But for now, historically, it has not happened. Think about it this way. As an Indian citizen, when you think about investing overseas, how many of us has the caliber or the stomach to pick and choose particular securities across the globe, right? It's a hard task. And only professional, skilled investment managers can do it, right? On the other hand, when you talk about Indian equity, most of the participants entering the market are entering either through direct stock routes, right, or through mutual funds, right? and many of them through passive mutual funds. In all these cases, they don't really care what type of securities they are buying. They're just trying to catch the highest mover or the quickest mover. Right? So it doesn't really matter. So that's the difference. When you go to international markets, when you think from your point of view, that is what the other investors also thinking, right?
Right. Got it. All right. So when we also look at a particular market, we're looking at the corporates, like how we said when we're talking about gold versus equity as an asset class. We're also talking about how looking at specific companies who are also not too expensive to buy right now is important. So while talking about corporates and the corporate earnings growth that we talked before, if we move to the fundraising that's been happening in that corporate space, since the pandemic, we have seen a massive wave of corporate fundraising, right? So should investors be concerned about companies raising capital so easily?
So first thing is that it's a good thing. When financial conditions are easy, it's a very, very positive aspect for corporate India, right? When fundraising becomes difficult, doing business becomes difficult, right? So it's a good thing to happen. And we had the opposite scenario when ILNFS fiasco happened in 2018.
Correct.
When fundraising became very, very difficult. So first thing is it's a good thing. Second thing is, do investors should worry about fundraising? I don't think so, right? What investors should worry about is what type of fundraising are they participating in, right? You look at the fundraising cycle, you will see that a lot of funds are being raised by companies which are not very profitable, right? And why are these companies raising money? Because they can, right? This is the environment to raise money. Because they are able to raise money, they are raising money, right? But bull markets, or what I have termed as easy money environment, also cause misallocation of capital, right? And why does this misallocation of capital happen? Because a lot of investors feel that they will quickly turn around and make a lot of money just by participating in what is happening, right? Whether it is an IPO or a fundraising or a debt fundraising. And that causes capital to flow to places where it shouldn't, right? And that, I think, is the worry, where as investor, you have to be discerning where do you put your capital to work. And that should be your yardstick to think about easy money environment.
So if currently we are operating in an easy money market, as you mentioned, in that case, does it not signal a potential risk down the road for investors?
Yeah, it is a very cyclical sort of a phenomena, right? Uh, Easy times always create hard times in the future. You can actually, think about it this way, that when there is an easy money environment, capital gets misallocated, and that misallocated capital eventually causes future problems, right? It can get it could be an elongated cycle also, like we saw in US in 1990s. It went on for about 12, 13 years. So there is no way to judge, right? Nobody can say whether this cycle is for 3 years or 30 years. I have no clue how to judge it, but as I said, the only thing that you can do is be more discerning rather than being more aggressive, and you have to be more conservative in your approach.
And when you mentioned that investors should look at how they are raising money, from where they are getting that capital. So with IPOs making up 63% of the equity funds raised last year, what does this tell us about the quality of new listings? Do we see a shift in the kind of companies going public?
I think so. A lot of companies going public, many of them have not enjoyed very high profitability. So that is a cause of concern. Also, their listing multiples have been very high. Right? And we have highlighted in the past also. In 2021, we highlighted that we had one of the best IPO years. And you need to think about when IPOs become very, very high in numbers. You go back in history and see those years. When do they become, ever present or omnipresent? Is when conditions are very easy to raise money. That is when IPOs come out. So think about this. If a promoter wants to sell equity, when will he sell equity? When he's getting a higher buck for his share, right? When he's valued it at a higher multiple, then only he's going to be willing to sell it, right? Second thing is, when other participants are very ready, they are ready to part with their capital, right? For whatever it's worth. So these two environments are present at this point in time, and you need to be very discerning. Where do you want to put your capital? So we calculated a number that a lot of IPOs in small and mid cap space which have come in the last 2 years have gotten listed at a multiple of more than 70 times trailing number, 70 times trailing earnings. I don't know what kind of earnings growth can justify this multiple over the next 3 to 5 years, right? So if you think about pure from a mathematical standpoint, it does appear that most of these issues, I won't say all, most of these issues will be available cheaper than they were when they
Hmm. So when we are talking about these small caps and mid caps, last time we touched on market stability. Now we are seeing a big surge in promoter selling also in these small cap and mid caps. So does this change your view on market stability at this point in time?
So my view continues to be conservative, as we spoke last time also. So there is no change in view. B, there is no market timing mechanism, right? You can't look at this number and say then this is it, right? It can continue, it can keep on going on, and we've seen that these sort of episodes have a longer shelf life, right? And the reason is that a lot of people get sucked into it, and the capital available for this environment to go on keeps on rising rather than falling. It's a folly, but it happens, right? You can't, and there is no indicator to tell you that it's over, that this is it, and fundraising will become more challenging. You can't call it by looking at any specific indicator. So what is the way out? One, when you see this kind of environment, you become more discerning, or you become a fence sitter. It's like going and watching a movie, but you don't participate in the movie. You enjoy it. You enjoy it from the outside, and that is what it is right now in this specific case. And a lot of promoters, as you said, they have raised about, we calculated, which is our own estimate. It's not the exact number. It will be closer to the exactness, but it's not exact. We've calculated that small and mid cap promoters have diluted about 1.4 lakh crores of equity over the last 20 months or so, which is an all-time high, right? And why not? I mean, when they are getting such a high multiple, you think about a promoter who runs a company and who is able to sell his stake at 70 times multiple. Justify that number, he will have to show a 40-50% earnings growth. So why should he work so hard to show that number, right? Very few promoters will do. Of course, some will do, no doubt about it. But many of them will say that this is the easy road, let me dilute. That is what is happening. And you think about the person who's offering that capital for this dilution. So one of them is going to lose. It's not very hard to think who will lose.
Right. So if you're looking at, if like for example, with the number that you mentioned, 1.4 lakh crores, it's at an all-time high with how the promoters are selling their stakes.
Yeah.
If I'm a retail investor, should I give any weightage to promoter selling when making an investment? And if yes, then what is the weightage that should be given to this particular phenomenon?
I don't know what the weightage is, but if you're an individual investor who's investing in mutual funds, then your fund manager will already keep this data in mind when he picks the companies that he's picking, right? If the fund manager, he or she picks a firm and they look at the fundraising structure of the company, they will be able to discern whether new fundraising is actually causing the company to grow further or not, right? So that call the fund manager will take. But when you're doing on your own, right, if you're a DIY investor, largely I think you should avoid companies which dilute equity again and again, right? If, for example, a company has retained earnings, and if they are able to grow the retained earnings with the same ROE if they are making, it's a great company. And if they are able to put the capital back to use, but if they need consistent capital to grow and their return on equity comes down, then I think that growth is not it. That company is not a great company to be in at that point in time. So some of these parameters can work in your favor when you look at how much promoters are diluting.
Got it. So after discussing everything around where India stands as against other emerging markets and about corporates as a whole, I would want to dive deeper on certain sectors and the opportunities lying in there. Tech, banks, staples, and precious materials, as you talk about in your this month's report. So when we look at Chinese tech valuations, these stocks are trading at significantly lower valuations compared to US tech giants, right? Despite having huge cash reserves. So do you think this is a value opportunity or could it be a value gap?
So first thing is that many US companies are cash making machines, right? They generate huge amount of free cash flow. They have very strong balance sheets. They have a tremendous visibility of earnings going ahead. So for at no point are we saying that United States technology companies are inferior in nature. They continue to be the most superior technology play across the world, right? But what China offers is margin of safety, right? So and the problem is that when the margin of safety is high, you will find million reasons not to participate, right? Because you have tough regulatory environment, you have bad short-term business dynamics, companies are struggling, earnings growth is not happening. So it's very difficult to see through that pain period, right? So the only thing that can happen at that point in time is that you participate, expecting that these companies will come back stronger. And one of the reasons why you can bet on that is that they have cash reserves. So they are not going to run out of cash. They can survive. For example, Alibaba kind of a company which was trading at $300 billion market cap and with a cash reserve of more than 100 billion, is more than able to ride out any pain period, right? So that I think is one of the most important points. And then over the last 3 to 4 quarters, we started to see that some of these companies have started to report good numbers. Their earnings growth has started to turn. That I think was strong enough signal to tell you that something can happen in these companies over the next 3 to 5 years, right? And you don't know what the trigger will be. In some of the Chinese names, we started becoming positive in March of this year, and they fell actually after that, instead of going up. But you had this trigger of stimulus, etc., which we had no clue will happen or not, and we still don't know what will come out of it. But they offer a margin of safety. And think about this: that the whole stack, the top 10 Chinese internet companies, were being offered at $1 trillion market cap. Chinese own economy is $20 trillion, roughly about $19 trillion, right? And you compare this to United States, where the companies are global in nature, they were available at $16.5, $17 trillion in aggregate market cap. So China did offer a more better margin of safety bet, and I think it still continues to do that. So whether it is a value trap or not, only future will tell, right? I don't know, but the idea is that it has margin of safety, and when you have margin of safety, lucky surprises occur, right? When you have margin of safety. If you do not have margin of safety, bad surprises or nightmares occur. So this has margin of safety, so you can expect it to hold. You can hold on to your investment and then see what happens.
Also, just for everyone to understand, when we talk about good surprises and not so good surprises, when we're talking about margins of safety, could you explain that, what those could be?
So first thing is that what do I mean by margin of safety? When you buy a investment, let's say $100 investment at, let's say, $70, right? So there is a possibility that 70 will go back to 100. It will mean revert its original value. You're buying it below its intrinsic price, right? So if something favorable happens, the ability of that investment to go back to its original intrinsic value is high. When you buy an investment which is worth 100 rupees, but you buy it at 120, you are playing what is called the greater fool theory, that there is going to be another guy who's going to buy it at 121 and I'm going to get out, right? So that is an expectation which may or may not happen. But when the investment which is worth 100 rupees and you buy it below 100, right, 60, 70, 80, whatever price, the probability that you will make a loss is much lower, right? Because there is some catch up to do. And that is where these positive surprises or lucky breaks can occur, which you do not have any control over. For example, a government stimulus or a favorable regulatory change, right? Or a favorable M&A or some other instances. And we've seen this occur. Maybe I'll take you back to my original career as a equity research analyst for one of the local companies, Eicher Motors. We made a model saying that it's tying up with Volvo, it will change its game. And the stock will rally, XYZ will happen. Whole hypothesis was made, and stock did remarkably well, not because of our hypothesis. It did really well because of motorcycles. which we had no clue, right? We did not know that it will become such a big business over time. So hypothesis did not play out, but the stock played out, and it was available at cheap valuation at the beginning. So that is what I call by lucky breaks. Maybe it was a lucky break entirely because the analysis completely failed, but you still made money.
Yeah.
So that is what marginal safety offers.
Right. So when you're talking about these valuations of these Chinese companies, do you think the multiples being that low are justified given the uncertainties going around China right now?
I think the corollary is also true, right? If there are no uncertainties and there is a regulatory tailwind, there will be no low multiples, right? Companies will trade at exceptionally expensive multiples, right?
Right.
Why will they trade cheap? So these two conditions come together. So maybe if you think about this, good companies will never trade cheap unless there is a problem. Why they do trade cheap, right? They will not trade cheap. And if a company is trading at a very cheap multiple, you cannot have everything rosy. These two things don't come together, right? All great investments come to you offered in bad times, right? And therefore, you have to be discerning and think about them very, very deeply, that whether the problems are persistent, they are going to remain here and blow up the business, or are they more cyclical and they will go away over time, right? Just prior to COVID, 2019, India and China over a 10-year period were performing very similarly. Our returns were similar, but then there were regulatory issues in China which blew up many businesses, right? Whether they're permanent in nature, I don't know. Right? I have no clue. But once you start trading at, let's say, 7-10 times multiples, which many Chinese companies were trading at, you have very less chances of losing capital, right? You might not make a lot of money, but the possibility of losing capital goes down.
Got it.
So while talking about these opportunities, I'm going to jump from one topic to another. So after talking about this, I want to talk about gold and silver pricing. The report brings up that some interesting ways to value gold using monetary-based methods, which also helps derive silver prices. So one, I would want you to explain what monetary-based methods of deriving gold's value means, and then how reliable do you think these approaches are in today's market environment?
So I'll answer the second question first, that they are not reliable. Okay, so there is one thing is that you cannot make money by using Excel sheets. Okay, it's not possible. If it was possible, then it would have been very easy. It's inherently it is supposed to be hard. Okay, so these models are theoretical in nature. They are a construct to help you think about how you should value. By no means they offer a hard perspective on what should be the value, right? It's a theoretically derived price. And why do we use it? Because we use an assumption saying that gold is money. And how did that assumption come about? It is our collective fictional imagination, right? So for example, what is the value of a rupee or a dollar? Is the collective fictional imagination of all the people using them, right? That piece of paper doesn't have any inherent value. And similarly, what is the value of gold? It is how we think about it, right? So one way of thinking about this, what is the assumption that gold is money. So when you take this assumption and then you calculate what is the total amount of gold that has ever been mined, which is above ground at this point in time, the number I put in my report is about 6.83 billion troy ounce. That is the amount of gold which is available. And when you look at USM2 or money supply or monetary base, all the three terms are the same, which is how much money they have churned, right? How much money have they produced over time in dollars? It's $21 trillion or $21,000 billion. So if you divide 21,000 billion by 6.83 billion troy ounce, you get the price of gold, which is at 3072 ounce, okay, dollar per ounce. That is the per ounce price for gold in dollar terms. And why are we using the dollar? Because we are pricing gold in dollar. And also because it is the reserve currency of the world, right? And we also take, let's say, one more assumption I put is taking half the monetary base of Eurozone. And the reason is that because Euro is also a reserve currency. I am taking no other currency because no other currency qualifies as a reserve currency. And what is the reason? There are other reserve currency in IMF basket, but I'm not taking any of them. The reason is that most of other currencies are also backed by the dollar and the gold itself. So you cannot repeat or do double counting, and therefore I'm not taking them. So if you take half the monetary base of Eurozone and then divide do the same exercise, gold price will come to about in the range of about 3072 or 40 or $100. So $3,000 to $4,000 is roughly what this model says. Okay. And then how you drive the price of silver, you just take a gold silver ratio, which is at 60 to 1 in the 21st century. In my report, I've highlighted how it has moved from 9.5 to 1 to about 100 to 1 at various points in time. What we are saying is that we do not know what the ratio is, but let's assume it will go back to its average of the 21st century. Okay, which is 61. If that is true, then gold price, given what we had, $3,000 to $4,000, silver should trade between $50 to $70. So these are some yardsticks to think about how should you price both these commodities, assuming that gold is still regarded as a currency or a store of value, right? So this serves as a benchmark of how it will move and how you should think about the price.
So this 60 to 1 ratio that you mentioned about from gold to silver, it is still relevant in the modern day time for investors to analyze the two assets?
Bhave, it's like a problem of induction. Let me tell you that you could say it's a dumb historical data extrapolation. There is no justification to it. I can't offer you a scientific justification why it should be not 40:1 and why it should be 60:1. There is no justification, right? What we are saying is that what was the average in 21st century, can it go back to the average? You can draw some empirical reasons why it should be where it is right now in terms of, silver's usage as a store of value or its growing usage in technology. You can put justifications. But as I said earlier, it is a derived price from gold. On its own, I don't know whether there is a theoretical model to value silver on its own. I have no clue. It's very hard. And therefore, we are using gold as a yardstick and benchmark and then try to value silver.
Got it. So again, talking about gold and gold's pricing, it seems to be tracking the 5-year CAGR change in the US debt. But silver hasn't shown the same correlation, right? So what do you think is the reason behind that?
Most likely, the reason that I see is that participants have not been able to see momentum in silver prices, right? Which is sort of the most dumb reason that I can offer. It is a answer which is hiding in saying that I don't know, right? I have no clue why it not happened. Historically, we've seen that whenever precious markets move up or that you have a bull market in gold, silver, platinum, palladium, silver outperforms gold. That is what has happened historically. One of the reasons why I think it happens is because silver also has other uses. Rather than being used as a precious metal, it is also used widely in technology and other areas. So start extracting silver inventory for investment. So a lot of people start buying silver for investment. The marginal investor will bid it higher and therefore it outperforms. So in this bull market, as of now, it has not happened. One reason could be that other metals have also not participated a lot, the other base metals. So that could be one of the reasons. But I'm sort of optimistic that it can play out. And I base my optimism, A, on historical behavior of silver prices. B, I think if the gold bull market is prolonged, and why will it be prolonged? Because the debt binge, global debt binge hasn't stopped. Countries are still borrowing huge amounts of money. And that is a favorable condition for gold over a longer term. If gold continues to move higher, silver will also get repriced.
Got it. So when we move to banking sector valuations at this point in time, banks contribute around 25% of profits, but only make up 12% of the market cap in the NSE 500, right? So what kind of opportunities do you see in this gap right now?
So first is that this 12% market cap is a aggregation, right? So 12% means denominator has all the banks, their market cap put together, and numerator has NSE 500's all stocks market cap put together. It's not the index weightage, right? So that is the difference between this ratio. The reason banking is making a lot of profits is because the balance sheets have improved, credit cycle has been good, and banks have generally done very, very well. Why have they not been given higher market cap is anybody's guess, right? They're out of labor right now. There were certain regulatory changes, overhead, overhanging problems for two large banks, change of management, merger, etc. So those could be some of the reasons why investors haven't really looked at this sector. Second is most other investments were outpacing small cap themes, etc. They were generating huge amount of returns in the short term. So it is overlooked or underowned right now. And I think it is the only sector which trades below its long-term average valuation. So we think it's one of the most attractive places in the market right now. And when will it move higher? We have no clue. It's like saying that you have margin of safety, you participate, then wait.
So last time we discussed the quality factor in stock picking. So at this point, if you're talking about banks and banking sector, does that fit in that theme? With the current valuations, you think it's a quality stock to pick?
I think many banks will fit in that parameters. I won't say all of them will fit because many banks are still struggling with their credit cost or quality of their assets, but many banks will fit. More banks will fit in this criteria when you compare it to other sectors fitting in their own criteria.
Right. Got it.
So lastly, I would also want to discuss about the consumer staples versus discretionary point that you mentioned in your report, right? So the consumer staples are trading at historic lows relative to consumer discretionary. What typically drives these cycles between staples and discretionary sectors?
So largely, I would say that the aggressiveness of the consumer is what is primarily responsible. So when there are good times and disposable incomes are high, people salaries and wages are growing at a good clip, you will see that discretionary consumption goes up at a much faster rate. Right. So what is discretionary consumption? Consume a item like an automobile, a car or a vehicle or a brown good or an iPhone, right? When do you buy these stuff? When you feel good and your salaries are going up, right? When times are good, their consumptions actually are much more healthier. But for staples, the growth rates are more middling, right? So you're not to consume toothpaste and atta more just because your income has gone up, right? So their volume growths are more stable in nature. But why do these cycles occur? Because investors bid up prices of discretionary stocks to a very high level because they see good demand in the short term. So that is what has happened. For about 2.5 to 3 years, we were big participants in consumer discretionary, specifically through autos and other sectors. We think that trend is beginning to run out, and possibly to look at staples more from a defensive standpoint also, and also because I think they offer relative safety in terms of being a hiding place for investors.
So in that case, how do you think the investor should be thinking about the sector right now? Because even though the staples look attractive compared to discretionary, they're not exactly cheap on an absolute basis.
That's true. So on an absolute basis, they continue to trade at high multiples. Their multiples are much lower than they were 3 years ago, right? They were trading at such high multiples that there was no case to be made even to participate in them. But now they have come down, but they are still trading at rich valuations compared to other parts of the market. So the only way is to be purely bottoms up. We think that there are about half a dozen stocks, even in this sector, which offer some value, at least average multiples, where you can participate. So they can be a sizable weight of your portfolio, but not too large, right? So as I said, it can be a hiding place, which can maybe protect you from market volatility or declines in the market, but you cannot expect very high absolute returns.
So now we have discussed everything from where India stands against emerging markets. We've discussed gold and equities as a class. We've also discussed what's happening in the corporate space in terms of fundraising as well as promoter selling. And then we've also discussed a few sectors, given the Chinese tech versus the US tech giants, also the banking sector in India, and again, gold and silver as commodities as well. And then lastly, the consumer staples and discretionary.
So, given what all is happening in India and across the globe, with even another war being broken out, where do you think the investors should be at this point in time when they're looking at making certain investments, when it's not through a mutual fund, when they have to take their own decisions? What are some of the things that they should be cautious about, and how should they be going ahead with making investments at this point in time?
First is that they should be very, very quality conscious. I think that is the first thing. Do not participate in stocks where you do not have a good track record. I think that is the first thing. You should have a good track record of a stock for certain period of time. Second is look only for profitable ideas. Don't look for ideas which will turn or can turn profitable. You can avoid them because markets have repriced many of them already. Third is look for credible signs of good management. And it's very, very hard. Like it's a statement which has been repeated for hundreds of years. But I think how I think about it is that ignore bad management. And they're very easily predictable, bad accounting or bad decisions or high equity dilution, etc. You can just eliminate them and then, look at your list over the longer term. And last is be very conservative while building your equity portfolio. You can have lower allocation to equity, a sizable allocation to bond and let's say gold, sort of a multi-asset allocation sort of a framework in your own portfolio. I think that will serve investors very well.
All right. I think you talk about how multi-asset allocation wins in the longer term as well in your report when you begin it. So I think that's a theme that we can end this discussion with also at this point in time. I'm sure people will have amazing takeaways from how they should be looking at this market at this point in time, because there's a lot of uncertainty going around the globe, and how people want to cater to their investing needs even domestically. I think there's a big question mark that comes in there in a lot of people's mind. So thank you so much for again taking out the time and discussing the entire report with us and sharing those insights for our viewers.
Thank you very much. Thank you for having me.
Thank you, Sahil. It was great having you.
Thank you.
And well, that's all for this month's brain picking with Sahil on everything markets and economy. Stay tuned as we discuss the mega trends and noteworthy signs in the markets and the economy every month.